Okay, guys, here we go. We have three indexes here. We have the Dow Jones 30, and we have the S&P 500. We have the NASDAQ. Now, these are three different indexes. You're going to see these a lot. Pretty much all they're doing is giving you a general idea of the top 30 companies, like the Dow Jones 30. Uh, a lot of investors always look at this um, throughout the day just to kind of give a snapshot picture with with uh, with the last 30 stocks or the top 30 companies in this particular exchange. What are they doing financially? All right. So you'll see somebody say, "Oh, the Dow went down 500," or "the Dow went up um, 300 points," or "the Dow went down 400 points." I mean, a lot of investors they look at this index to kind of get a general idea of the market. But the new investors, what we do is we look at the S&P 500 because even though a lot of investors look at the 30 top companies like ExxonMobil, General Electric, um, uh, Johnson and Johnson. I mean, these are the big boys in the game. But I don't know about you, but to me, the market is 500 companies or 500 stocks. You know, like Macy's, Nextel, I mean Netflix, Nike. You will definitely know. I would rather look at 500 companies to get a general idea what the economy is looking like than 30 companies. You get my drift here? But a lot of people look at the Dow Jones as a barometer or a like a thermostat to kind of figure out what the economy is doing out there. But as new investors, follow me and try to follow the S&P 500, and this will kind of give you a snapshot picture of what the real world is going on out there. These are big cap stocks here over here. These are like mid to small cap stocks here. Over here, the Nasdaq is more like a have 3,000 stocks in it, over 3,000 stocks in it actually. And what happens is the Nasdaq is more like a tech stock. You may see Apple in there. You're going to see Amazon in there and Dell. These are the tech stocks, and a lot of these guys here are pretty much like in the technology industry, so to say. So what they do is, guys, is they separate. Let me draw this here. They separate these companies into indexes. Only thing they are is like a bundle of stocks. So you have 30 stocks over here, or 30 big companies, and they just put them all in one hat, or all in one basket. Or over here you have 500 companies, all in one basket. And over here you have over 3,000 companies, all in one basket. So what they do is they just separate them, and you can also you can actually trade uh, the Dow Jones, right? You can actually trade the Dow Jones. The ticker symbol is DIA, which we call it diamonds. You can actually trade this whole index here, all right, on the market. All right. You can also trade the S&P 500. We call it the spiders, SPY. You know, you type that ticker symbol in, and you can actually trade this whole index here. All right, which is 500 companies in here. You can also do the same thing with the Qs. You know, the Qs, as far as the Nasdaq. Now the Qs is trading off the Nasdaq 100. All right. So yeah, just to give you a general idea, you can actually trade these whole indexes, which I think would be a great idea if you are not into mutual funds. You can treat this as a mutual fund investment strategy by just trading this whole index individually. All right. So that's pretty much what happens, guys. It's just they separated all these companies into different hats to kind of separate everything to make sense, try to make sense out of everything. That's all. It's trying to organize everything so people can kind of like get a feel or get a snapshot picture of these different levels and grades of the companies. That's all. All right. So that's pretty much an overview of indexes.